All right, what is happening, everyone? Welcome back to another episode of The Deep End. This is big number 29. We're almost at, I almost said triple digits, but we're almost at 30. Cool little milestone. Hope everyone's doing good. Ari, how are you doing, man?
I am doing well, Ryan. We are just about at $300,000 in the brokerage account. So, I mean, I'm ecstatic about that. And I know I keep sharing that episode to episode, but I need money to hit
No, it's
my
cool. I want to
savings
hear
for
the
me to
update.
transfer it to my actual brokerage account. I'm like, it's the in-between days where I like didn't yet transfer it. It's there. I might as well consider the account above 300,000, but I'm not going to do that until it's officially in there. Either way, I'm excited about that. What's been going on recently for you?
Wait, real quick, man. So just so I get this right, as soon as the transfer hits, you'll officially be above 300K. Is that right?
There's a method to my madness. First of all, I have, and way back when I created this system for myself just to understand, how much money's coming in, where's it going, and so it's like I called it the pool system, right? So I would get paid, and it all goes into a one checkings account that I have open with Chase. And then from there, I divvy it out into different pools. And so one of those pools was Capital One. That was the emergency savings. And then that would tap out. And then I'd switch, kind of throw more money then into my brokerage account. And then I have some spending. So whatever needs to be spent, bills, groceries, this, that, and the other. But right now, because of that tax return savings that I had, that massive lump sum that I didn't have to pay and I cut in half, I paid my taxes. That's also done. It's like feels like bricks off my shoulder. Okay, so that's behind me. And
Nice.
I'm just waiting for about $5,000 to clear in my Capital One account to transfer over to my Vanguard brokerage account. That will put me over $300,000. And it takes like, I don't know, 4 or 5 business days from Chase to Capital One. So I thought it would be there already. The weekend hit. It's not there, but it should be there within a day or two. So definitely by next week, I mean, I'll be above 300,000 in the brokerage account officially while chatting with you.
Oh, that's awesome, man. And excuse me, I've got a little frog in my throat. We're recording a little bit earlier than usual. I was telling Ari before we started. I'm just still kind of waking up, so you guys will have to forgive me. But man, that's awesome, and it doesn't hurt too that the market's just been on a tear this week. Um, Dude, as I'm sure you are as well. I'm sitting at, and all of you guys are listening. I'm sitting at all-time highs right now. We've just surpassed like $104,000. So
Let's
it's been,
go.
yeah, it's been pretty crazy, man. That's I don't know. I think we're up just about, I mean, honestly, about 3,000 ish just over these last couple of days. I would imagine, and this is always how it goes. I would imagine though, like one day this week we'll have some red day where it's going to just level things back out. It's, I don't know. That just seems to be how it goes. We see these all-time highs, or at least in my portfolio, see these all-time highs, and then there's going to be a red day that's going to bring me back down to like 102, maybe 102.5. But nonetheless, I'll take it. Could definitely be worse. So that's where we're at.
Ryan, your red days of like concern and worry are like nothing, right? Like you're like, yeah, I'll drop like 2K. In my portfolio, I'll drop like 15 to 20K any given red day.
But dude,
So
that probably doesn't at this point because you've built your portfolio basically brick by brick. You've had the chance to acclimate to those swings, whereas and so it probably doesn't even phase you. I mean, correct me if I'm wrong, but yeah, it probably doesn't even phase you as opposed to if you were to have, come into that same amount of money. Let's say you were, inherited $300,000 out of nowhere and just immediately put that into the market. You would notice those swings a lot more than if you did it your way, where you just built it brick by brick. You have the chance to get adjusted, get acclimated, get used to the daily swings. So I would imagine it doesn't even phase you one bit.
Not at all. I mean, I don't even drop a sweat. I'm not losing sleep. And I'll tell you what, I think the way that I built my portfolio is a testament to my ability to sit that calmly, because it's not only about, the experience as an investor, having had about a decade's worth of time experiencing the market in of itself, which is really important. And that's like in all facets of life. You're going to go through experiences. You hopefully, if you're wise enough, you're going to learn from them, and you learn how to sit in the volatility of life, the volatility of the market. And that plays a major role. But also, what plays a huge role is how you build things, how you go about, your goals in life. And so, what I did that keeps me at such a calm is the quality positions that are in my portfolio. I don't have to worry about. And this might be something for us to chat a little bit about here as I'm really thinking about this. Those investors who have like 40, 50, 60 positions, okay, who want to make the case for diversification, which, yes, that is a facet of diversification. But as I always say, you can still be highly diversified with the less is more approach. And that's where I sit. I've built these massive positions that are with quality companies across industry verticals, which gives me that diversification. But really, the added benefit is I've invested in only the top tier quality stocks versus people who go with that, diversification of dozens and dozens of stocks to try to hit that same diversification aspect. It's kind of, I'm kind of thinking about the credit rating system in my head, right? Like you got triple A's, you got AA, and then you got A, and then you get down to the triple B's. I don't have triple B's in my portfolio, so to speak, right? I got triple A's and at worst double A's. And so what that gives me is a tremendous footing to relax and just stay put when I drop 20, 20, I don't know, 20 points, or 20% rather. And I think that's really important. And now I'm just thinking about this. So I sent this over to Ryan the other day, but Ryan and I had an amazing comment come in from a viewer out there who's 21 years old. He sent me this direct message on Blossom, which, by the way, everybody, podcast is in fact powered up by Blossom. And if you are looking to understand investor insights from the masses of investors, transparently see what I'm investing into, what Ryan's investing into, you know exactly where to go. That's Blossom. There's a link down there in the description and pinned comment.
And they're
Either
also,
way,
sorry to cut you off with Blossom. They're in the process too of expanding too. So right now it's really only in North America, but they're just getting ready to expand to, I think, like over 30 different countries beyond that.
oh,
So if you
man,
live outside of the United States, if you live outside of Canada, get ready because
get
Blossom's coming
ready.
your way. Yeah.
Oh man,
Ready or not.
I didn't know that, man. Wow. Get ready. That means I was talking to an Italian investor the other day. They're coming. Italy
Yeah.
and all the EU, so that's exciting
Yeah.
news.
Anyway, sorry,
Um,
man. I didn't mean to cut you off. My bad.
no worries. This individual, this 21-year-old, I actually invited him on to join Ryan and I today, but he couldn't be with us. He's actually working, so amazing. Kudos to him for working and getting out there to make money. But his questions actually prompted this question: as a young investor, what should he be most focused on? And I'm going to have a much deeper chat with him off the deep end. And I think Ryan, he's going to actually send you a DM as well on Blossom soon. But
He did. I just haven't had the chance to respond yet. I'll get back to you after this conversation, man.
so let's chat a little bit about it right now. Someone in his position, he's 21, and I almost feel like one of the questions that's going to come our way is how to just start investing. I mean, he's saying that he's looking up to us. We have different approaches right now to the market, and I'm sure we're going to have different answers to this to some extent. But Ryan, let's talk this one out for the younger investor out there. 21 years old, 18 maybe, 20, however
Yeah.
old you are. You're getting started. You're looking to retire early or make the millions. How do you start?
Well, I honestly don't think we're going to have two different answers on this. Like, I'm in the same boat as you are. You want to buy things that are going to grow. You want to buy growing assets. Some would say, and maybe the phrase that could be used is you want to buy growth. But I don't know. I don't necessarily want to. And this kind of expands beyond this question too. But I don't know that I necessarily want to put a label on it, because I think no matter how old you are or what stage of the investing game is, you want to invest in growing assets. You want to invest in things that are going to be bigger tomorrow than they are today. And so, yeah, by definition, that would be growth. So get things that are just going to grow over time, things that are going to get better over time. Buy quality investments. And once again, I don't think that that's exclusive to anyone at any specific age. I just think that that's like the main premise of investing in general. But what does that look like for you? I think if you're someone who's just starting out, don't feel too much of a rush to pick individual companies. If you want to maybe try your hand with a couple of them, there's not necessarily anything wrong with that, I don't think. But I do think if you're just starting out, if you're just getting going and you're brand new to all of this stuff, I would encourage you to do what I wish I would have done when I was in your shoes, and that would be to go very heavy into diversified ETFs. I don't think you need 10 different ETFs or five or six or seven of them even. I think you maybe need a good one, maybe two, probably no more than three. And it's simple enough just to go into the S&P 500 and call it good, or VTI, which is the total U.S. market, and call it good. You could throw some VGT in there. I know Ari's a big fan of that bad boy. You can throw some VIG, some VYM, some SCHD. But I would encourage you to just stick to ETFs. Ari, I'll throw it to you because I could probably talk in circles from here, but I'll throw it to you. What do you got for him?
Well, first of all, answer. I can only add to it, and what I'll share though is that, So you said two things I wanted to highlight. Actually, you said no matter the age you're starting off at, you're starting, and this is how you should start, and I agree with that. So let me loop back, not just for the younger investor, for any investor who's really getting started. This is I think an ideal way to get started, as Ryan was already starting to lay that foundation for us. The only thing I would really add is just make sure that you are building a foundation. I think that is so key, because I'm just thinking, now, and I kind of came full circle. So I started off investing in a total stock market fund. And that was a big lump sum that I threw in. I think it was like 20,000. And then I didn't touch it for a bit. And then I started to invest in individual stocks. Now, the first problem is that I stopped for a bit because I just threw my lump sum in there, and then I did nothing for like a couple of years. And wow, the couple of years I could have been, just firing that bad boy up. But that's all right. So once you get started, don't stop. That's that lesson there. The second thing, though, is where I want to say that I came full circle, is I started investing heavily in individual stocks. I grew the portfolio up to 30, 40 holdings, and then I trimmed it all the way back down to less than 10. And now I'm really just hyper-focused on my main ETFs, which, S&P 500 you cannot go wrong with. And then more excitingly is that tech ETF that Ryan had mentioned. And, for me, those are gold. And the more I realize that I love researching companies. I have my picks. I'm not doing a whole lot of research anymore because, I'm kind of thinking like, okay, if I were the CEO of United Health, or I was the CEO of, Visa or Google, or Apple, I wouldn't have a lot of time to be researching other companies. I would be so focused on mine. And so I designate all my time really with the stock market these days to just what I'm already invested in. I believe they're the cream of the crop. And then I'm just throwing a lot of money into the foundational ETFs that I have. And so I think that's the magic approach. And you also mentioned, Ryan, that looking back, I want to go back to you looking back. We both have about a decade worth of experience now. And
I'm about half that. I'm about 5 years into it.
oh, okay. Wait,
You
so you
got
started around 25.
Yeah, I started. I started around 25, 26, somewhere in there.
Okay, so about a decade, give or take, and then Ryan's got half that amount of time, but still a sufficient amount of time, I think, to ask this next question here. What's the one thing that, and I know you always say, because we've talked about this before, like you wouldn't really change anything, it got you to where you are
Hmm.
today. But like, I don't know. I kind of find it hard to believe you just wouldn't change anything. You think you would stay exactly the same strategy that you've used, the dividend stocks. Like would you build up the S&P 500 position more? Would you focus there more at the start?
Yeah, I probably would. Like knowing what I know now. Yeah, if I could go back with the knowledge that I have today, I probably would not start the way that I started. And when I started, it was no ETFs. It was all individual companies, and it worked out just fine. Like I've done pretty well over the few years that I've been investing. So I have my no regrets tattoo for that. But but no, knowing what I know now, if I could go back, I probably would start, yeah, just more diversified in ETFs, build up the S&P. I probably still would have some SCHD. I don't think that I would change my emphasis on dividends, or my preference toward investing in dividend paying stocks. I just think that fits me like a glove. This style of investing fits me like a glove. So I don't think I would necessarily change that component to it. But I had no business picking individual companies when I was first getting started. I just had no idea what I was doing. And the downside of that is I had no idea what I was doing. But the upside of that, or the silver lining, is that, throwing myself into the water, or into the fire, I guess, whatever the phrase is. I need more coffee, guys. But throwing
Let's
myself
stick to
into it,
water. It's the deep end. Yeah.
yeah, there you go. But throwing myself right into it did force me to learn, and learn quickly. Simultaneously, starting a YouTube channel soon after I started investing definitely, played a role in that as well. So I do think that there was some good that came out of it. I don't think I would have been as I don't think that learning more about this stuff and how to analyze companies would have been as urgent for me if I wouldn't have started the way that I did. But at the same time, you don't necessarily need to learn how to analyze companies to be an investor. So there's that side of it too. But I'm very interested in this stuff, and I like doing it. It's a hobby for me. I have fun doing it. And so, I think so. I'm happy to spend the time picking individual companies. And that's also another thing that's, as we've talked about before, that's important to know about yourself, is how involved do you want to be? How hands-on do you want to be? If you do have an interest in this and you like learning about businesses and what makes them tick, then yeah, I think maybe having some individual companies is a good thing to do, because it scratches that itch. But if not, then don't feel like you have to. And at the same time, even if you do have an interest, I still think it makes the most sense as a brand new investor to build that foundation, like you said, Ari, and maybe pick one or two companies that you're already familiar with to as your test dummies in analyzing a stock. Does that all make sense?
Yeah, for sure. I think the one thing I would do is I wouldn't have picked the total stock market. I would have actually just
Mm.
chose the S&P 500 itself.
You think
Um,
the total stock market's just too diversified? Like there's too many holdings, or what is it
yeah,
about
man.
that?
As I keep investing, and I got to be honest, man. This year was a very powerful year for me. It's not even over. We're halfway through, or just a little over halfway through. But entering into this year, 2025, I was already, I feel like, on this momentum train ride to get to my financial goals that I had in mind for last year into this year. But this year in and of itself, again, just a little over halfway through, has been transformative,
Mm.
because man, I've been running, this is crazy. I've been running Masters of the Market now for like a little over a year. Um, and that's just nuts that I've, you know, every week have managed to secure, new guests and have, I think, really amazing conversations. Um, I have learned a lot from everybody. I love learning from people who do not invest the way that I invest. And I want to be challenged as an investor. I think people who are stuck in their ways are ignorant, they're so closed-minded that they're going to literally shut themselves out from doors among doors of opportunities. And so the one thing I did starting at the very beginning of my Masters of the Market chats was like, let me just learn how other people are doing this and see what I can pull from them, and kind of take what I like and leave the rest, and then I started doing that, and I started redeveloping my own strategy, and then take two, I started really, really cracking down on my portfolio and less is more approach. And man, I'm at $300,000 in there. It's like, that's, and the last big, massive chunk of that, about $100,000 of that came within under 12 months. That's nuts.
That's crazy.
So where am I going with this is like, don't be in a rush to build some portfolio that that's quote unquote diversified in the way that you think. Build the portfolio that's going to get you to where you need to go. Yeah. And I just, for that total stock market to the S&P, it's such a minuscule percentage. I think it's like 1% of a difference in terms of gains. But like 1%, if you really think about the power of 1%, it's actually pretty substantial when you start talking about 1 million, 2 million, 10 million, 1% is a pretty big deal. Not a big deal when you're talking about $1, or $100, but a massive difference in even 10,000. You start talking about these big differences. So if you look at the S&P compared to the total stock market, the S&P comes up just a tad. And I don't like leaving money on the table. So I wish I would have just invested in the S&P 500 and built that position. I'm going to say a crazy number, to $100,000.
Mm. How much, what percent of your portfolio, I should ask, is in the S&P right now?
28%. 28 to 29% as I last looked.
So you're about there right now.
Give or take.
Yeah. Just under.
I have. Go ahead.
Just under 100,000.
I have a little bit more in my tech stocks, my tech ETF, and because the reason I have that, and this is actually something interesting too. I'm just thinking about. I would have been more focused on that as well, and this comes from an interview I just did. Again, Masters of the Market chat. I had a bright kid on, hard worker, up in Canada. Did you catch this last Masters chat, Ryan?
I did. He's a Blossom user.
Yeah, Blossom user. Again, another pitch there for Blossom forever. You got to jump on Blossom. It is just the coolest community ever, I think. It's so fun to connect to other investors, constantly getting the DMs and talking to other investors. Ryan, I'm sure you're doing the same. There's just nothing like it. Anyways, I was talking to him. I'm like, how about you join me for a chat? First of all, I think young investors should hear what he's saying. It's incredible insights from such a young investor. But second of all, his approach was more income oriented. Now, I disagree with that because he's young. And I just naturally think you should either go S&P and then growth. You're investing in the S&P, you're getting a substantial amount of growth. But I just don't think young investors should be focused on income, man.
I don't think that it, and actually I'm glad that we're heading in this direction with the conversation, because I wanted to get to the point where we flip this question on its head. We've talked about how a brand new investor should start, how a new 21-year-old investor should start, a young guy. But so what I'm trying to say is we've talked about the things that you should do, but why don't we pull a Charlie Munger and invert it? Let's talk about some things that you should not do. What shouldn't you do? If you want to build a successful portfolio, starting from ground zero, what are some things that you should avoid doing? So your number one would be chasing income, right? That,
Yeah,
or not number
definitely.
one, but that would be one of the big things.
I think that would be number one.
Okay.
What about you?
And I want to stick to that for a minute because I really don't disagree with that. I think which might be surprising to hear because I am a diehard dividend investor, but I want to distinguish something here. I want to define something. To me, investing in dividend stocks is not about solely chasing income. To me, it's about prioritizing dividend paying companies. I do only buy stocks that pay me a dividend. Um, but still, going back to what I was saying earlier, they have to be growing. There has to be some growth there. I'm not willing to sacrifice, adequate returns, adequate and consistent returns over a long period of time. I'm not willing to sacrifice that just for like an extra yield over here. That's why you see me not investing in certain types of things. That's why I won't ever get into something like an AGNC or an Orchid Island Capital, an ORC, because yeah, even though you can get some solid income from stuff like that, they're not great assets. They're not great growing assets, and once again, that's still important to me. So all of that's to say, I actually agree with you on that. If you're going to buy dividend paying assets, you need to make sure they're of a high quality. That's true regardless of whether or not the stock or ETF pays a dividend. So I'll leave it there. Sorry.
I'm right there with you. What you just shared, I think, is really important, even for all dividend investors to understand. And this is something I've actually been saying for quite some time now. I feel like in a bit different terminology, because a lot of people have literally witnessed my portfolio go from some higher yielders, not crazy high yields. I'm talking like maybe around 3%, cut down to like less than 2%. And they're like, what are you doing? You're not a dividend investor anymore. What a fraud. And I'm like, actually, every company pays a dividend, and it's not about the yield and the income for me right now. And that's what I feel people really have to understand. Like before they make that comment and they hit, I don't know what actually YouTube's thing, reply or whatever, post, whatever. Before they post that comment, really make sure you understand somebody else's investor profile. And then really also just make sure you understand their strategy, because as someone who's young, yield is not why I'm investing in the dividend stocks for the income right now. I'm investing in these stocks to hold on to for the income they're going to pay me later based on a growing dividend. And that's just so important. And every company in my portfolio, aside from Amazon and Tesla, let me make that clear. Amazon and Tesla are in there. They do not pay a dividend. Who knows? Anything's possible. Maybe they will one day. And the only reasons I picked up Amazon and Tesla was because Amazon was on a great deal. So I made a great deal of money from it. And Tesla, if I had to buy a car right now, I'd buy a Tesla. And so I stand firmly with Tesla there. And I don't have a substantial amount in Tesla. It's actually one of the smallest positions in my portfolio. But where I'm going with that is, this is not about now, it's about later. And I don't, I was on the Masters of the Market chat. I understood where this young investor was coming from. And again, great guy. I think he's going to have a killer future, like an amazing future as an investor.
Yeah, he had about sorry to cut you off. He had about a 20 something thousand-dollar portfolio, right? Or
Little over,
maybe it
about
was
21,000.
Yeah, yeah.
And he was getting paid roughly any given month between $800 and $1,000 a month in dividends.
Well, strategy aside, like I've got to say too, and this I won't get super deep into this because this is another conversation that I want to have, but it is, no matter what the strategy is, it's so cool to see someone that young with a portfolio that size. Like, that's awesome. I'm just going to leave it there. That's really cool to see.
No,
really
I commend him like nothing
Yeah.
else, But again, the reason why I started Masters of the Market is not to have people on and say like your strategy sucks and mine's the best, right? It's actually to say your strategy is working. Tell us about it. I could be wrong.
Mm-hmm.
And so I like having, like I said, I like having people on and talking to people who have different strategies, and we're all getting to the same point together, and we all have the same goals together. Now, his strategy was primarily based in income ETFs, using leverage and high income yielding ETFs. I don't disagree with the strategy. I disagree in the timing of the strategy, because I think there's a time and a place, and I would just like to see a young investor around 19, 20, 21, all the way up to 30, even 35, 40, really focusing more on the growth aspect.
Yeah. And I think that can kind of tie us into, or lead us into, maybe another thing not to do. The second thing not to do, at least I think, it's don't be in a rush. Do not be in a rush. Especially as a young investor, you are so young. The greatest power that you have, the greatest thing working for you is time. The fact that you don't have to rush and have so much time to let things grow and compound and snowball is your greatest strength as a young investor. So take advantage of it. And I know, like, I get it. We want what we want and we want it now. But when it comes to investing, you have to, especially when it comes to investing, you have to actively fight against that temptation and that want for things now and that immediate gratification. The name of the game is delaying gratification. It's interesting. It's like the more that you can do that, the more that you can delay gratification and do things today for the benefit of tomorrow. The more that you can do that, the better off you're going to be. And so that would be my number two, is do not rush. Do not worry. You will get there. Your portfolio will grow faster than you think it will. I understand that it starts off slow. And once again, we want what we want. We want it now. When we start, we already visualize ourselves at financial freedom, and we want to get there as fast as possible. But take it slow and steady. Things will grow. Put it into good assets, good growing assets. Just let them grow. And that's the thing about like high quality investments, is they get better with time, but you can't rush it. You have to let time do its thing.
I like that. I really like that. And I think that ties into income and yield chasing, because the rush. I need to be financially free by tomorrow. And what's interesting to me is when you ask people, what do you want to do when you're financially free? Like, yeah, there's the aspect of like sitting on the beach and reading a book all day. Like, but you can only do that for so long. Okay.
Sipping coconuts like we were talking about last week.
Yeah. But both you and I would agree that we would still be working in some capacity or giving back. And so like it always works out that people who are like, I need to retire early. Most people pick 30. That's what I did. I think you might have done the same thing. It was like, I need to be a millionaire by 30. And okay, so we're not there yet. And I'm rest assured, like Ryan and I will both be there eventually. But we're enjoying the journey. And I think that was a great switch. Once I stopped running on full throttle to be a millionaire by 30, I'm actually enjoying the journey. And if you read some people, the journeys of some people who have actually done that deal, Grant Sabatier is a great example. Are you familiar with Grant Sabatier, Ryan?
I've heard of him, but I'm not super familiar with him.
So true story. He wrote the book Financial Freedom. It's a blue cover. It's an amazing book.
Oh, you've told me about this before.
Yeah. So where I'm going with this.
I think maybe you've talked to him in the past.
Yep. He published the book.
You messaged him on Instagram or something.
This is when he was
like
small,
that.
man. Like he was in small potatoes.
Okay.
Like,
Sorry.
No worries. This is Small Potatoes Grant Sabatier, and I was like, wow. I read his book. It was powerful. And I messaged him, and he had like I think under 1,000 followers on Instagram at this point, and we had a great conversation on Instagram. And believe it or not, he actually graduated from U Chicago 1 year ahead of my brother. So I even threw that in there. I was just excited to talk to him. And the reason why I'm bringing Grant up is because Grant actually talks a lot about like the hardships of being in a rush And then like the not a there's no need. There's no need. He was like, I literally lost so much of my life trying to get to this point. You know, like he was proud of himself getting there. He wasn't sharing he did it his way, but he's just sharing that like he failed to enjoy the journey more. And because of that, it created very dark, low spots for him along the journey. And, you know, as I just sit here, and first of all, you know, doing a lot of work with people in those dark spots, people with depression and anxiety and addictions, and and having been in those spots myself, I can tell you, it's so silly to be in a rush to hit a financial milestone. Like if your life depends on a financial number, you might want to recheck how you're living. And something that just keeps popping into mind for me is, and this is what my dad always shares with me, you know, you don't want to be the richest man in the cemetery. What was the point? And it's just so true, man. I'm financially free as far as I'm concerned today. I don't have a worry in the world. I sleep at night. I have peace of mind. If I stop investing now and I put all my $300,000 into the S&P and don't do anything more, I'll still be, you know, 11 million by retirement, which is crazy.
That's crazy, man. And I got to say, like, that's an incredibly powerful thought. You know, going back to myself when I was first starting out, I thought that like the only way that I was going, like, because I started doing this out of working a job that I didn't like, and I thought, you know, this is like my way out, investing. But I don't know. I think I kind of, to your point, I needed to check my premises. If that was going to be my only way out of this job, I wasn't thinking about it the right way. You know, if I had to wait 20, 25 years and sit in this unhappiness for that long, I just wasn't thinking about it the right way. You know, there's other ways that you can change your situation. Investing is great, and it can be that for sure, but it's not the only way. You know what I mean?
For sure. Yeah, I have a number 3 that I'm thinking about right now. So I have 2 of them, but I want to
Okay.
throw this one out there to get your thoughts on it, and maybe we can rank it if you don't think it should be number 3, but it's an interesting one. Don't surround yourself with the naysayers. And I think that's really important because a lot of times we are, and thank God, I mean, I don't want to pitch Blossom too much here, but like, thank God for Blossom, because this is a way to actually do the exact opposite of that. A lot of us are just surrounded with people who are going to energy drain us, and the naysayers saying, don't invest in that. You shouldn't be doing that. Why are you putting so much money into the stock market? Come out, party tonight, you know, spend money over here. And it's like, I just think that if you're not surrounding yourself with naysayers and you're putting yourself in the right mix of investors and people who are forward thinking and optimistic, this is where some real dividends can get paid out. What do you think about that?
Yeah, I think it makes it a lot easier if you can if you can avoid any sort of negativity. But I also think that's just, it's almost impossible to do. I mean, you should have the willpower to be able to say no to certain things that are going to, you know, negatively impact your budget to the point where you can't invest. I think if you're going to be an investor, and if you have a goal to, you know, do things for your financial future, there are things that you're going to have to say no to when it comes to, you know, spending money on certain things. But I think that comes with the territory. I think when it comes to, because you talked about people maybe saying don't invest in that or whatever, I think especially if you're active on social media, no matter whether it's on Blossom or Twitter, or we certainly get this on YouTube, you know, everyone's going to have an opinion on whatever stock. It doesn't even matter what it is. There's going to be people who think it's a good investment. There's going to be people who think it's a bad investment. And, case in point, whenever you go to buy a stock, there's someone on the other end who is selling a stock. You're buying it because you think it's a good buy. Someone is selling it because they think its best days are behind it. And so, yeah, I think you're always going to be exposed to, opposite opinions of yours. And that's just what makes the world go round. But that just goes back to knowing what you own and having conviction in your own investments and understanding the why behind why you own a certain thing. You know what I mean? So some of it, I don't think it's easily avoidable. But it is something that you have to go through and persevere through for sure.
I'm just saying, like, I have the privilege and honor of being able to chat with you almost on a daily basis, and then literally live on the deep end. And then me and you both have a tremendous, privilege and honor to be in our positions now where we're talking to a lot of investors. And I just feel like it's so important to surround yourself with the optimists of the market, because there's a lot of pessimists out
Oh
there.
yeah. Yeah, I
And I
definitely
think when
agree
you
with
hang
that.
with the optimists, they just will push you forward. So I want to say, like, don't hang with the pessimist. Like,
Yeah.
don't hang with the naysayers out there. Everything's negative,
Ah,
or you
yeah.
can't do that. You shouldn't do that. It's like when Ryan comes to me with a stock idea, or you guys even hear it here, like, there's never been like one time where I've been like, "Psh, what a crap investment." It's like, oh, like, talk to me about it. Like, let me see your angle. And it's just like, I think that's just so important. And then in that, you're surrounding yourself with people who are going to help you challenge yourself to think and maybe see things in a different perspective, versus surrounding yourself with people who are just calling you out for quote unquote, being an idiot or not understanding the market, or like, why would you invest there? It's like, well, why wouldn't I invest there?
Yeah, well, that's a great point, man. And people's opinions, it stretches far beyond just individual securities. It can expand to whole investing strategies. I mean, I get so much, and every day I get so much pushback for investing in dividend stocks. I can't tell you how many times throughout the day I'll get comments. It's usually on a short, like a short video, which totally draws a different crowd than the long form videos. Just fun fact for you guys out there, totally different crowd. But I get comments every day about how my portfolio is basically going nowhere because I invest in dividend stocks. And it's always people who, because you can look and see how many times this person has commented on, videos on your channel. 9 times out of 10, this is that person's first comment. So they're working with no context about my portfolio. They don't even know what my holdings are. They don't even know how the returns have been since I've started. And so they're just not working with a lot of context, and that's going to be true in most cases. And that's why it's especially important not to put too much or to take those opinions with a grain of salt, because the context is often lacking. And also, with that said too, there's none of this is black or white. There's so much gray area in all of this. And as Ari, as I think he was trying to, as I think he was alluding to when he was talking about masters of the market, just coming in with an open mind and coming from a perspective of, hey, this seems to be working for you, tell me about it. I think that really speaks to the fact that there is more than one way to skin a cat, or skin the cat. You guys know I love that phrase. And like I said, you'll get different opinions about different investing strategies. You can be a dividend investor and you'll get pushback. You could just buy the S&P 500 and you'll get pushback for not having enough, like, Bitcoin. Or you could just invest in Bitcoin, you'll get pushback. You can just invest in yield max and you'll get pushback. It doesn't matter what you do. There's always going to be people there who are ready to try and tell you you're doing it the wrong way. So, but you have to invest in the way that suits you best. Maybe that turns out, if you're starting out, you might come to find that turns out not to be the way that you ultimately stick with. But at the same time, this is your journey. And if you come to that conclusion, it's something that you'll come to on your own versus some random person telling it to you in a comment on Blossom or YouTube or wherever else.
You want to know the number one comment that is like just such a pet peeve of mine to read? It's like the
What
number
is it?
one type of comment that people will leave that just like, I'm like, oh, like I just shake my head and I'm like, I just pity you.
What is
Can you
it?
take a guess?
Um,
I feel like you might be able to like I've fetched enough to you about this sometimes.
is it on specific to your channel, or are we talking like
Specific to
deep end
Masters of the
comments?
Market chats.
Okay. I don't know what the specific one is, but I'm guessing it has to do with maybe, well, kind of the same thing. People not agreeing with the guest's style of investing, and so maybe they
Yeah.
tear you down for platforming them or something
They're
like that.
like,
Is
why would you have this person on Masters of the Market? And I'm like, well, you just said it in your question. It's Masters of the Market. These people are seeing great returns and they're paving a way forward for other investors. Hence the entire idea of the series. And so it's just such a bummer. I have learned, I've had technical analysis guys on. I am not a technical trader. That's not
yeah,
me. But
no,
I have learned so much. I'm thinking of one in particular who went from $15,000 in debt and started day trading. I am the farthest thing from a day trader. But I have learned in that hour that I spent with him so much about, first of all, technical analysis. It's still not my thing, but I've learned about it enough so to say that's a pretty solid strategy. The second thing is I have learned so much about his mindset that it's helped shape my mindset in a way in which I can use that mindset for my strategy. And so it's just like, oh, it just kills me when I read these comments. People are like, I stopped watching after a minute and 33 seconds because he said day trader. And I'm like, I want to slap you across the face. Like you literally are unwilling to learn for the sake of learning because you think that you have all the answers.
hmm
Like you think that your way is the way, And I'm like, oh man, I just get like, it gets me because I'm like, we're in this game to learn. And why shut the door on a potential opportunity or potential new mindset or a potential perspective? It's crazy to me.
yeah. Well, to your point, maybe in listening to that, to whatever the conversation is or whatever the Masters episode is, maybe there's one little nugget at there that you can take and apply to whatever style of investing that you're doing. You don't have to take it as a personal attack on the way that you're doing things, but maybe as a way to learn something new and implement something that maybe you didn't think of before. There's a lot of ways to cross pollinate to in investing strategies, and that's really what you're doing, is offering those different voices to maybe do that, to maybe add something to your arsenal. But yeah, I think it's especially with the since so much conversation is happening on these social media platforms, I think it's become pretty easy to let how do I say this? It's become pretty easy to let your investing strategy become tribal. It's almost like you've joined a gang if you're a day trader or a dividend investor, or you invest just in covered call ETFs, or you're a boglehead. It's almost like you've got your people and everyone else is an idiot. Um, and it sucks that I guess I kind of understand that in a sense, because that's human nature, and the same thing happens outside of investing strategies too. It happens with sports teams. That's another very tribal thing. It's happened, since human beings started getting together in groups. It's always been that way in a sense, and so I do understand that it's just baked into our DNA. But yeah, maybe try and fight against that. Maybe try and not take things so personal. I'm sure that's, and we're all human beings. Like I'd be lying if I said I was completely impervious to feeling that way, because sometimes things do get to you. But still, you should try and realize that there is more than one way of doing things. And once again, you just have to find the way that works for you. So, and that's developed over time. That's another reason, going back to not being in a rush. That's another reason why time is so important, because in the same way that this is a journey of building wealth, it's also like a journey of self-discovery and evolution. Just being an investor and spending time with this stuff and thinking about this stuff and learning more about it has, um, it's trickled into other areas of my life for the better, for sure. And in more ways than one, like I'm a different person because I'm an investor, and that will happen. And that's only come with time and experience. And you can't rush that, and you can't fake that either.
Yeah, 100%. And I think you hit the nail on the head. It's in every aspect of life. And I'm even just, I don't, we're not going to get into politics, of course, but it's like there's another
So there you
aspect of
go.
our lives where
Yeah.
we're losing, we're literally losing our grip on sanity because we can't bear to understand someone else's point of view these days. It's childlike, in my opinion. And if we're ever going to progress, we're going to need to understand. We don't have to agree with, but we need to understand. I don't need to agree with the technical analysis trader, right? But I need to understand where he's coming from. And most importantly, the question when I engage in a conversation, I never am engaged in the conversation looking for how I'm right. I actually flip that. And I like to go into every conversation saying, how might this individual be right and I'm wrong?
But
How
it might
might
not
I
it
be
might
wrong?
not be like a right or wrong type of thing. You know what I'm saying?
Yeah,
It
it
might
could
not
both
be
be. I mean,
so
two
it's
people
not
can
so
just like
binary.
they can coexist, these opinions. But I'm just saying, like, I actually challenge myself to be wrong
Like, what am I
because
missing?
it's only in
Hmm.
that analysis. For me, I've
Okay.
found that when I approach it with a very hard lens stance, I'm like, where am I wrong? Like, there's a definitive answer for success. Where am I wrong? And I'm like, oh, like, actually, if I look at it from that point of view with this day trader, like X, Y, and Z, and I'm like, oh, okay. But then do I want to use that approach? And then it becomes a game of different questions. But
Yeah.
yeah, when I got off the call with the day trader, I got to be honest, I sat for like a good 20 minutes and I was like, huh. I was like the guy literally became a millionaire in a couple of years. Like, it was
Yeah.
like boom, 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 and like, but then I looked at my risk tolerance and I looked at a couple other factors, and they're not me. That's not me. So I don't know. I'm just very hard on myself, and I'm hard on, and I think a lot of people who really quote unquote make it in life, or a lot of people that other people look up to, they tend to be harder on themselves, putting themselves under that microscope. Because I always say this, I have a great privilege to be in a couple of different positions where I'm like, a community head. And so I will always have the mindset of, well, all eyes are on you, and so, and one of the best pieces of advice I ever got was actually working in Manhattan real estate from a very successful individual who was my mentor in real estate. And he said to me, Ari, don't ever do anything that would get yourself on the front page of the Times. And if you could just do that and understand that like eyes are always going to be on you and they're going to be watching you, you're going to go very far. And I've ran with that because I love that, man. Like, if all eyes are on me, and whether or not they are or not doesn't matter, right? And then I'm like, oh, the eyes are always on me, right? Like,
Right.
if I could be in my own home, and it's like, what are you doing inside your own walls? Is it something not so cool, right? Like, you got to just be focused on this thing. And I don't know, man. It's created an element that for me, I love to live by this standard, this element of, okay, behave in the right way. And so someone who's going to if someone's sitting in front of me right now, you're in front of me right now, and we have a massive disagreement, maybe on investment strategy. My job is not to sit across from you and say, I'm right, you're wrong. My job is to say, where could I be wrong or looking at this in the wrong way, to which Ryan is actually also right. That's the way I'm kind of thinking about it all.
That makes total sense, man. And you know, all any of us who have read like the psychology of money understand how much behavior goes into, your financial decisions. That certainly applies to investing. And so if nothing else, it's just interesting to know like what behaviors or what aspects of that person's psychology draw them to a particular kind of investing. Like I know why I like being a dividend investor. I know the some of the facets that draw me to this style of investing. What does that look like for a day trader or someone who invests just like does like momentum trading? Um, what does that look like? I don't personally get it. It's Yeah, I don't personally get the draw to it, but some, those who are in it certainly do. So what does that look like? And I think in asking those questions or approaching it from that point of view is going to help you understand that person a lot more. And if you approach it with that lens, I think it's easier to make it not be so binary, so right or wrong. Um, and instead it's just like a discovery, I suppose. But also to your point, Ari, I live by a similar, I don't know, a similar way, I suppose. Like my spin on the New York Times thing is, um, how I phrase it is if you can't talk about it, you probably shouldn't be doing it. And so that's kind of how I try and approach everything.
That's a great mindset or a way to live. I love that too. It's so elementary, like these lessons that we learn in elementary school, we like forget about, we grow up and we make
Well,
all
dude,
the
it's
mistakes in the world. I
it's
just want to
so
throw this out there because it's like
yeah.
it's literally out there in the news right now. But this whole Coldplay
Oh
concert
yeah.
and this whole
Oh,
so
oh my
he
gosh,
wrote,
that's so
and
crazy.
this is actually this is
Oh,
epic because not only does it tie into this conversation, but it's business related or finance related in some sense. But okay, so he writes after the fact. He resigned and he wrote a memo or whatever, just kind of sharing like, okay, he knows that he messed up and he's so sorry and he's it was the greatest honor to lead, whatever. I just want to get to one aspect. At the very last paragraph of this memo, he signs it off by saying, and I just want to say I think it's wrong that Coldplay had a kiss cam that's targeting individuals who are there for private reasons. I just wanted to say, and I want this on record. What a schmuck. What an absolute schmuck. Just admit that you're wrong, admit that you got caught, and shut up.
yeah,
That's like I just want to say that outright because this is where we're going wrong. You know,
yeah.
you write this whole nice, okay, I messed up and I know that, but, Coldplay shouldn't be spinning a kiss cam around. I'm like, dude, come on.
No, dude, it's all on you. 100% on you. And that's case in point. Like if you can't talk about it, if other people can't know you're doing it, don't do it.
Don't be
Don't do it.
smooching around with HR, that's a lesson learned.
Yeah. He was almost there, almost took full accountability,
Yeah.
but then he had to screw it up with that stupid ending.
I think the best part is it's HR. Can we just talk
Yeah, I know.
out of
It's the
all
irony of it,
people?
man. Of the irony of it, of course.
Now we're almost coming up on the hour. I want to squeak this don't out there, but I want to say, and it's kind of interesting because what I'm about to say could be confused with our point number 2, which is don't be in a rush, but don't delay what you can do today and to do tomorrow. And what do I mean by that is still don't be in a rush. This is not like the mindset of like I need to be the millionaire by Tuesday. What I'm getting at with this one though is like when you get paid, don't delay putting money into the market or paying yourself first, thinking that you're going to have an abundance to put in at the end of the month or after everything is said and done. And I think that is something that a lot of people struggle with. And they're like, oh yeah, after I pay this off and after I do this and after I do, it's just like, dude, just get your paycheck and take off 10% or 15% or 20%, whatever it is, and put it in the market and then don't think about it. So don't delay that. And that's very different from don't be in a rush, I want to say.
Absolutely. It's don't be in a rush to reach the finish line, but also you can't be so nonchalant about it that you completely forget your portfolio exists. Consistency in your contributions is like almost equally as important as the time component. It's honestly actually more important when you are just starting out. If you are starting a brand new portfolio from scratch or up to a certain point, um, your contributions are what will do a lot of the heavy lifting in the growth of your portfolio, especially early on. And that's why Charlie Munger had that whole $100,000 number. And I know inflation, guys, nowadays 100K, it's really like 2 million. But that's why he said that back in the day. It's because once you get to a certain point, it almost kind of switches where instead of your contributions doing a lot of the heavy lifting in the growth of your portfolio, now you're reaching a point where the compounding, where just the growth of the portfolio on its own will start to move the needle a bit more. And I've already experienced that here in my portfolio. We just hit 100K like a couple weeks ago. We're already at almost 5% of the way to the next 100K just in a few weeks. Granted, things have been really good, but the needle wouldn't be moved so far if I only had a $10,000 portfolio. So that's why, yeah, don't be nonchalant. Don't be complacent with your contributions. Hit those hard for sure. Hit those hard, but also be patient with the growth of it. But you have to do your part as well.
Can I, just before we end, can I throw you in the hot seat?
Yeah, let's do it.
We
scared.
named no, it's not that. We named 4 don'ts, and I'm just a stickler for at least
We gotta get
you know
five. Dude.
when we went on our run, it was like mile 6.9 whatever, and I was like, we just keep going. We have to get to the next mile. So
Yeah.
I just feel like it's we need to get to that 5th don't. Ryan, what's the 5th don't?
Dude, I've got it right here. I've had it ready to go. It's been waiting to get out. And, I'm with you, dude. I would have felt weird if we stopped at 4 or 5. It's a nice,
Who does 4?
It's a
That's
nice
weird.
even number, No, number 5, and we've already kind of talked about this one, but, right out of the gate, don't over diversify. Don't go in on 40, 50, 60 different companies. Don't do that. You're going to be better off, like Ari says, less is more. If you're going to go 50, 60 different companies, you're better off starting with an ETF. And the thing about that, at least in my experience, when you're starting out, it is so easy to just collect all these different companies. You start watching YouTube videos, you hear all about all these different companies that people own or are talking about. You go on Blossom, you see people buying this, that, or the other. You go on Twitter, people are talking about something else over here. And you don't know any better when you're first starting out. You think you need all these stuff. Well, I might as well get a little Procter and Gamble. I might as well get a little bit of Oscar Health, maybe some Hims. Oh, why don't we get some ULTY as well? It's so easy to just collect different stocks and ETFs. Don't do it. Don't do it.
I like that. In my head as you're talking, I was like, don't be a vacuum dividend investor, just vacuuming everything up. And then
perfect.
I was like, because my mind keeps running and I'm just thinking, everything you're talking about. I'm like, you know what it's also like? It's like going to, and I don't know if these still exist. You ever go to a Chinese buffet?
I haven't been in years, but I used to love them when I was a kid. Really good
Me too, man.
chicken
Those
nuggets.
donuts. Oh, I was going to
Yeah,
go for the sugar donuts. Amazing.
Yeah.
But in my mind, I'm like, don't be the buffet guy, or a girl out there who's like nitpicking every little thing. Go to a 5-star restaurant and get some good food. Get a really good plate. I'd much rather go because those places were expensive. If I'm not wrong, I remember like an all-you-can-eat Chinese buffet being like ridiculous amount of money.
Well, I will say, because there's a lot of buffets here in Vegas, and they can be pretty pricey. There's some where you can get them like 25, 30 bucks maybe, like if you go to the Excalibur. But yeah, typically the buffets here, you're looking at $65 a head usually, if not more.
And to be honest, like buffet food is good, but it's like it's so American, man. I don't know. I just gotta say, like, to just stuff your face and you don't even, after you go to a buffet and you get too much, you got too much. You don't even really enjoy the food. In my mind, go to a nice 5-star restaurant, pay the same price, and get a really good dish. And that's how I look at the portfolio, right? Go with the highest of quality. I like that you came full circle at the end of that. But you know what? Investors, this really now begs the question from all of you. What are some of your do's and don'ts for other investors out there who are just starting out or looking to pivot and really drive returns in the end of this year or heading into next year? Give us that list of do's and don'ts down there in the comments. Ryan, back to you. Close us out, man.
Yeah, I just want to thank everyone for tuning in. This was a really fun episode. It's so funny because we don't ever plan these. We had no idea what we were going to talk about coming into this, and that's just the cool thing. Like, as we wrap up this conversation, looking back, it's like, man, another good one, and it's cool to know that it wasn't scripted, not planned, just two amigos having a good morning chat. So, but anyway, super stoked to have all of you tuning in with us. Thank you guys again, and we will see you in the next one.